We use the NOA growth. Can you guys see my mouse? Good. Okay. We use the NOA growth to predict the future ROA. ROA is return on assets. It's like earnings, right? It's a fundamental performance. We use the total asset growth to predict the future ROA. We use the NOA growth to predict future returns. We use total asset to predict future returns. So let's look at ROA first. You can see that total assets growth predict the future performance. Good, in a good way. So basically, total asset growth can actually predict the future negative growth. There's a negative sign missing here. There's a negative sign. This should be a negative sign. It's missing. Just you guys, there's a typo. Okay, then sign missing here. And then let's look at NOA growth. NOA growth can also predict the future negative earnings, but in a more stronger way. So you look at the coefficient. The NOA, everything is scaled. The TA growth and NOA growth, everything is scaled. So you can compare them directly. So basically, when you moving from the bottom decile to the top decile, the total asset growth can predict negative future earnings by 2 cents. The NOA growth moving from the negative bottom decile to the top decile can predict negative earnings for 4 cents. So you see the magnitude is different, right? Magnitude is different, and also T-stat is also different. That means it's consistent with my theory. Consistent with that NOA growth is more negatively correlated with future performance compared to the TA growth, total growth. And the reason is, like I explained before, because the NOA growth is purely financed by the investors, the bank loans. Versus total asset growth has good growth and bad growth. The total asset growth has good component and bad component. So that's why the NOA growth can predict future negative return and sales in a more stronger way, with 4 cents and a higher T-stat, versus total asset growth 2 cents with smaller T-stat. So I hope that's clear for you guys. This is something you need to. That's the project you guys doing. You guys are doing. It's a simple, right? It's an easy project. And you horse race the two variables together, and you find that only NOA growth loads. The TA growth do not load. That makes sense, right? Because the TA growth contains good growth and bad growth, versus NOA growth is only about the purely bad growth. So when you horse race the two variables together, only NOA growth loads. The TA growth do not load. So that means the NOA growth is the actual bad growth here, drives the negative returns. So that's for the future ROA. That's for the future ROA. I told you guys, whenever you test the market inefficiency, you have to do two steps. First, you have to test whether the variable predicts the future performance, sales. The second step is, do investor get it? Do investor actually understand this? So what I'm saying is investors. What I'm saying is NOA growth can predict the future. Take it back. What I'm saying here is NOA growth can predict future negative earnings. Is that some information only you know, or is the information everybody know? You have to test that. You have to test that, right? So you already shown that the NOA growth can reduce 4 cents of earnings in the future. You show that. That's good. But is that 4 cents of earnings reduction, is that something you only know or everybody know it? So you have to test that in the future abnormal returns. So if everybody knows that information, the NOA growth should predict no returns in the future. Does it make sense? If everybody know NOA growth will depress 4 cents of earnings in the future, if everybody know that, you cannot, if you use NOA growth to predict the future stock returns, there will be no returns. Nothing will show up. Nothing will show up, because everyone will price the NOA growth in a very timely way. So when NOA growth can predict the future stock returns, only you know about the information. Other people do not know the information. So, and then in the next year, people graduate and learn about NOA growth. Actually, it's a bad thing. It can depress future earnings. If other people takes time to understand the information you know now, you can use the NOA growth to predict the future negative returns. That's the idea I explained in the first sessions. I don't know if that's clear for you guys. I know it sounds a little tricky, but this is fundamental for the market efficiency. Okay, let me just repeat it one more time in case some of you guys still confusing. For the future ROA test, we show that NOA growth can depress future earnings for 4 cents. That's the information we test. This is for sure. And then the second test we are doing is, are you the only person know that information, or everyone else know that? If everybody know that, when you use the NOA growth to predict the future stock price, you should see no returns, because the NOA growth is priced in an efficient way, in a timely way. However, if you know that information, other people takes 1 year to know that information, and then in the future year, you can get the returns from the NOA growth, because you buy and sell of the NOA growth ahead of other people. When other people do not know the information, you already buy. When other people do not know the information, you already sell. So because you know the information, other people can know a year later, so you can buy and sell ahead of other people. That's why you can realize the returns here. So that's why we always have a 2 test. You test the fundamental first. You use the signal to predict the future fundamental sales and earnings, and then you use that to predict the future stock price. If you don't see any results on the future stock returns, that means the information you tested in the ROA is already efficiently pricing. If the signal you can predict, the signal you use can predict future stock price, that means you are knowing something other people do not know at that time, and other people takes a little longer to understand the signal you produced from the balance sheet. So this is the test. You have to test it. Like I said, you cannot just just touch your head saying, okay, this is good theory, I like it, let's invest. This is you have to do the rigorous test to show that whether this kind of can generate a future profit for the investors. So let's look at these tables one more time. Okay, so the total asset growth predict the future negative return. Next, buy and hold 1 year. Okay, the abnormal return here is buy and hold 1 year. So annual return is about 9%. And then you buy and hold. If you use NOA growth, it's buy and hold 13%. It's about 13%. So what does that mean? This signal is consistent with the theory we talked about before. The NOA growth is purely bad growth that the managers doing empire building, financed by shareholders, bond banks. But the total asset growth is a combination of good growth and bad growth. So so you don't see much from it. You don't see much from it. That's why we have the we have the NOA growth. We have the NOA growth on the we have the NOA growth from the equation. The NOA growth generate higher returns than negative returns than the total asset growth, and you horse race them together, you run them together, you find only NOA growth loads and the total asset growth do not load. Is that consistent with the ROA as well? We see, you know, ROA, only the NOA growth load and the total asset growth do not load. Same thing here. When you predict the future stock returns, we have the same pattern. So here we get the test. What does the test tell you? The test tell you that consistent with our prediction, NOA growth is the bad growth. When the growth is purely financed by the investors, bank loans and the bond market is bad growth. The total asset growth contains of good growth and bad growth. It kind of supports the argument. And we also can run this. We also can run this separately. You can see that you can see that you can run this separately to see that the returns are different from each other. You can see that when you control, because you have to control for other variables. When you control for other variables, you can see that the returns are also, one is stronger than the others. Look at this is double sorting. This is double sorting. And we also use that to predict the short-term window. Do you guys remember last sessions I tell you guys why we want to do short-term window? Do you guys remember? The reason is because if you buy and hold for 1 year, there's a lot of risk. There's a lot of risk. You don't know the 10% of return is from the regret, it's from the signal, or it's from the risk. But short-term window is 3 days. How many things can happen in 3 days? Relatively less, right? Relatively less. So if you can get the return from shorter window, that is good. That is good. That means you can really gain money from the trading strategy. That's why if you really want to recommend the trading strategy to your parents, do not just simply do an annual buy and hold. You have to do really regular. You have to do buy and hold 1 year, to do 3 day, to do factor adjusted, to do portfolio sorting. After you've done everything, and tell everyone that's what I recommended. You know, you don't want to give reckless decisions to your friends or for your relatives, so you can do a more rigorous test. So here you can see that for the 3-day return, this is about 1%. This is about 1.8%. Do you know this is huge? This is huge. This is only 3-day return, buy and hold 3-day. And I take it back. Actually, it's not 3-day. So what we did is this is the 4 of 3 days. So it's the 12 days return. Okay, I take it back. This is 12 days return. So basically, we combine 4 3 days return together. So this is 1% from 12 days return. This is 1.8 from 12 days return. But this is huge. Think about it. You buy and hold for 12 days, and you get 1.8% after adjust for the risk. That's a huge. That's huge. So this is very confident. This is something, it's not risk driven. It's something there. This is something tradable. It's something tradable. So let's look at the test, the empirical test, to see whether it works. So you can see that. So you can see that. So you can see that the operating asset growth, operating growth, predicts the future earnings. So basically, asset growth financed by vendors and suppliers predict the future earnings. Predict the future earnings. And then what we see here is the financing growth. The growth financed by debt and equity is negatively predicting future asset earnings. So you guys see the difference, right? That's why this is good growth, this is bad growth. The growth financed by vendors predict future positive earnings. The growth financed by the equity and the debt predict negative future earnings. You see the good growth and negative growth. Okay, let's look at these two variables. This is suppliers short-term financing. This is government tax financing. You see that it doesn't load. It doesn't load. Does that confirm what I just claimed? Does that confirm what I just claimed? Earlier I was saying, suppliers short-term financing may be useless because this is short-term. So the data speaks themselves, right? When you predict the future earnings, it does not have a significant relationship with future earnings. Same as the tax financing. The tax financing also do not have significant relation with future earnings. So that kind of confirms what I said from early slides. That's why we need to take out the short-term financing from suppliers and the tax financing from the government. So to summarize, what do we learn from this table? What do we learn from the table is we have a good growth. The good growth is asset growth financed by vendors and suppliers and customers for long-term stuff. We have bad growth. Bad growth is the growth financed by the equity and debt. And we have the vendor short-term financing. It doesn't matter. It doesn't matter. It predicts nothing. We have a tax financing. It predicts nothing as well. So that's why we have a good growth here, and we have a bad growth here. That's the first test. We want to make sure theory-wise, we test the theory, make sure that's correct. And we'll keep moving. We want to do the short-term test. We want to do the short-term test to see if it also generates returns. So what we found is when we use these to predict the annual return, the return is about 4%. So the good growth can predict 4% of annual return in next year. And how about short window? This is a 12 days return. I forgot, this is 12 days or 3 days. Anyway, this is short window return. This is about 1%. So in a several days window, you have 1% return. For annual window, you have a 4% return. So you see that what's comfortable? What comfortable is most of the return are actually from the short window. And I told you guys why we like a short window return. Think about it. You buy and hold the stock for 3 days, comparing you buy and hold the stock for 200 trading days. Which one you would prefer? I would prefer buy and hold for 3 days. For 3 days, there's less events, there's less drama, there's less risk. If I hold for 200 trading days, a lot of things can happen. We may have another COVID-19 coming in the next 200 days. Yeah, so you never know, right? You never know. The longer you hold, the more risky events may happen in the future. So that's why we prefer we can obtain a return from shorter window rather than the annual window. So you can see that the results showing that for the annual window, most of the return, it's 1 divided by 4 is 25%. So what does that mean? That means if you trade the stock around earnings announcement, you can get 25% of return from your annual buy and hold. So that means 25% of return can be realized just by buy and hold around earnings announcement, the 3 days around earnings announcement. That's beautiful. That's beautiful because it's less risky. It's less risky. So so this is the things we just talked about. In the last class, I keep emphasizing how to predict the signal you have here is something you know, other people don't know. How do you know the signal, the operating growth can predict earnings? And this is the signal you know about, other people don't know about. I said 2 steps. The first step is you use that to predict the future earnings. It's positive. And the second step is you use it to predict future returns. If everybody know this one can predict the future earnings, you won't see the operating growth predict the future stock returns, because we can see that the operating growth can predict future stock returns. That means you are the one of the few guys know about this. A lot of people do not know about this. So when do they know? They know about this among the buy and hold in the following year. They know this in the following earnings announcement. That's why you can buy the stock based on the operating growth. And when do you realize the returns? You realize the returns when the future earnings is announced. You realize the return when you buy and hold for the subsequent year. So because you are the one of people know the signal, so you know the signal ahead of other market. So that's why you can buy the signal and use that to predict the future stock returns. But in case you don't see the significance here, so in case the operating growth cannot predict the future stock returns, that means what you know also is known by other people. Okay, that means what you know is also known by other people. So that's the I'm keeping emphasizing this again and again, so you guys understand how we form the trading strategy, how to test whether the one strategy is tradable or not. Yeah, and you can see that after control for other variables, so the signal, the positive growth predicts 5%, 4% annual return, and the positive growth predicts 1% return around earnings announcement. And we like the percentage. The 1 divided by 4 is 25%. We like that. We like that. This is empirically, it supports this is good growth. Supports this is good growth. And yeah, this is stuff. So another thing is we want to show this is not driven by risk. You know, I keep emphasizing that you have to make sure the 4% and 1%, it's tradable profit, is not risk. It's tradable profit, not risk. We have to do a lot of stuff to make sure that's the case. So the first approach we do is adjust for risk. So you can adjust for size, you can adjust for the book to market, you can adjust momentum, liquidity, you can adjust for a lot of risk factors. So the idea here is once you adjust for all these risk factors, if we still have an alpha there, that means this is not driven by those risk. Even it's driven by some tradable profit. That's one way we are doing that. But you know that there's one problem is you only can adjust risk. Maybe there's like 1 million risk there. You don't even know. That's what I discussed first class, right? So how do you make sure? How do you know you can adjust for risk? You don't even know. For example, COVID-19. Do you even know about the COVID-19? That's not on your list. That's not on your list. So how do you make sure the profit, the 4% and 1%, it's still tradable? Even you adjust for stuff, for risk, you don't even think about. So we have several ways. I will discuss. We have several ways to do that. The first is short-term window. We just discussed, right? The short-term window. If you have a high percentage return from short window, that's more confident. That gives us more confidence. In our case, it's 1% over 4%, so 25% from short window. It's very strong pattern that the profit can be obtained in 3 days around the earnings announcement. So short window can give you guys the confidence. This is tradable profit. It's not risk because there's less risky event among the short window. That's one way you do it. Another way we do that is look at the declining pattern. So let's look at the table here. Let's look at table here. We adjust for risk. We can do that, adjust for risk for short window. So let's look at the table together. So look at it. The positive growth can predict the following earnings announcement. And for the next following earnings announcement, it's a weaker result. For the third earnings announcement, no result. Fourth earnings announcement, no result. So what does that mean? That means the investors can, so that means, okay, let's go back to the story. The story is, you know the operating growth, it's a good signal. Other people doesn't know. That's your assumption. So when you see in the following earnings announcement, you realize 0.4% return. That means other people takes 3 months to know what you know. And then in the next earnings announcement, we have a returns. That means in the following 3 months, people are still learning what you know. What do you know? But in the 9 months, there's no return. That means what? Means in the next 6 months, people already get what you know. So in the 9 months, there's no return. There's no return here. And in the 12 months, there's no returns here. So that means what? It means it takes 6 months. It takes 6 months for investors to know what you know. It takes 6 months for investors to understand operating growth. It's a good signal, can predict the future positive returns and earnings. That's why we want to see a declining pattern. That's one of these decline pattern, because decline pattern consistent with the story we have. When you see a decline pattern, that's like I said, that means the investors takes 6 months to learn what you know. Takes 6 months to know the operating growth. It's a good signal to predict the future. In the 9 months, there's no return. The reason because no return, because they already know that. It only takes 6 months for them to learn. That's the story here. So let's look at the other case. What if it's significant here, significant here, significant here, significant? What if the whole 4 quarters, the subsequent quarters, are all significant? What does that mean? That means the investors takes forever to know what you know. It does not make sense. It doesn't make sense. If you see the significance continuing in the future, that means this is not about information you have. That's about the risk. There's a risk there. The risk keep predicting the premium in the future, significant. That's the story behind. So that's why we want to see a declining pattern here. That's one declining pattern here. When we see a declining pattern, that means you know something other investors do not know, and it takes 6 months for investors to know that this is a good growth. If you see a declining pattern. However, if you don't see a declining pattern, if you see significance over the 4 quarters, you cannot interpret as investors take 1 year or take forever to know what you know. It's impossible. Investors will know what you know eventually. If you see the significance over the future quarters, that means it's not about the information you have. It's about the risk. It's about the risk continuing associated with future risk returns, premiums. So that's why we want to see a declining pattern over